The stochastic oscillator is a momentum indicator used in technical analysis to determine whether a market is overbought or oversold. It works by comparing the current closing price to the price range over a specified period. The indicator consists of two lines, the fast line called %K and the slower signal line called %D. When these lines move above the 80 level, the market is considered to be in an overbought zone, which may indicate a potential sell signal. Conversely, when the lines fall below the 20 level, the market is in an oversold zone, suggesting a potential buy signal. Traders often focus on the crossovers between the %K and %D lines. When %K crosses below %D in the overbought zone, it may signal an upcoming price decline, while a crossover in the oversold zone may signal a potential rise. Although useful, the stochastic oscillator is most effective when combined with other technical indicators to confirm signals and reduce false readings. The stochastic oscillator uses two key zones to help traders identify potential turning points in the market: the overbought zone and the oversold zone. When the indicator rises above the 80 level, the market is considered overbought, meaning prices may have climbed too quickly and could be due for a pullback. This often signals that traders should prepare for a possible sell opportunity, especially if the %K and %D lines begin to turn downward or cross below each other. On the other hand, when the oscillator drops below the 20 level, the market is viewed as oversold, indicating that prices may have fallen too sharply and could soon rebound. This can suggest a potential buy opportunity, particularly when the two lines start to curve upward or form a bullish crossover. Although these zones offer helpful guidance, traders typically use them alongside other indicators in chart patterns to confirm the strength of the signal and avoid false entries.
A key part of using the stochastic oscillator effectively is understanding bullish and bearish crossovers, which help traders identify potential buy and sell opportunities. A bullish crossover, or buy signal, occurs when the %K line crosses above the %D line, usually in or near the oversold region. This crossover suggests that momentum is shifting upward and that buyers may be stepping back into the market. Once the signal is confirmed by sustained upward movement, traders may consider entering a long position to take advantage of a potential price rise. On the other hand, a bearish crossover, or sell signal, happens when the %K line crosses below the %D line, often near the overbought region. This indicates that momentum is turning downward and sellers may be gaining control. After the signal is confirmed through ongoing downward movement, traders may consider entering a short position to profit from a potential decline. These crossovers help traders read momentum changes early, but they work best when combined with trend direction, support and resistance levels, and other technical indicators to avoid false signals.
The stochastic oscillator is built on two main formulas, %K and %D, which together help traders understand momentum by comparing the current price to its recent range. The %K value, also known as the fast stochastic, is calculated using the current closing price, the lowest low, and the highest high over a chosen period, typically 14 periods. The formula subtracts the lowest low from the current close, then divides that number by the difference between the highest high and the lowest low. The result is multiplied by 100 to convert it into a percentage. This percentage shows where the current price sits within its recent trading range. The %D value, often called the slow stochastic, is simply the moving average of recent %K values. Most traders use a 3-period simple moving average for smoothing. By averaging several %K readings, the %D line becomes steadier and easier to interpret, helping reduce noise and false signals. For example, if the last 3 %K values are 50, 55, and 45, you add them together and divide by 3, giving a %D value of 50. Together, %K and %D allow traders to clearly see changing momentum and identify potential market reversals through crossovers and extreme zone readings. Stochastic divergence is a powerful concept that helps traders identify early signs of potential trend reversals by comparing price movement with the behavior of the stochastic oscillator. Bullish divergence occurs when the price on the chart makes a lower low, but the stochastic oscillator forms a higher low. This signals that although the price is still falling, the downward momentum is weakening. In other words, sellers are losing strength and buyers may soon take over. This type of divergence often appears near the end of a downtrend and can alert traders to a possible reversal to the upside, making it a valuable early buy indication when confirmed by other signals. Bearish divergence, on the other hand, develops when the price makes a higher high, but the stochastic oscillator makes a lower high. This suggests that even though the price is still rising, the upward momentum is fading. Buyers are losing control, and sellers may be preparing to push the market downward. Bearish divergence typically forms near the top of an uptrend and can warn traders of an upcoming reversal to the downside, serving as an early sell indication once confirmation appears. Because divergence can sometimes give premature or false signals, traders often combine it with trend lines, support and resistance levels, or additional indicators to strengthen their analysis and improve accuracy. The 1433 stochastic oscillator setting is one of the most widely used configurations in technical analysis because it provides a good balance between responsiveness and smoothness. In this setup, the %K period is set to 14, meaning the oscillator calculates momentum based on the last 14 price periods. This gives traders a clear view of where the current closing price sits relative to its recent high-low range. The %D period is set to 3, which means the %D line is simply a 3-period moving average of the %K values. This smoothing helps reduce noise and makes crossover signals easier to interpret. The third setting, slowing, set to 3, adds another layer of smoothing to the %K line, transforming it into a slower and more stable version that reduces false or overly sensitive signals. With these settings, the stochastic oscillator becomes more reliable for identifying overbought and oversold conditions, as well as spotting potential reversals through crossovers or divergences. The overbought level remains at 80, signaling that the market may be overheated and ready for a downturn, while the oversold level sits at 20, indicating that prices may be undervalued and preparing for a possible bounce. Overall, the 1433 configuration is favored by both novice and professional traders because it captures market momentum effectively without being too reactive to small price fluctuations. A simple stochastic trading strategy focuses on using overbought and oversold conditions, along with crossover confirmations to make clear and disciplined trading decisions. The first step is identifying an oversold entry, which occurs when the stochastic oscillator falls below the 20 level and then forms a bullish crossover, meaning the %K line crosses above the %D line. This signals that downward momentum is weakening and buyers may be stepping back in. Once this confirmation appears, traders look for an opportunity to enter a long position, aiming to profit from the expected upward movement. As price climbs and the stochastic oscillator rises above the 80 level, the market enters the overbought zone. At this point, traders watch closely for a bearish crossover, where the %K line crosses below the %D line, indicating that buying momentum is fading and a reversal may be near. This bearish crossover serves as an exit signal for long positions, helping traders lock in profits before a potential downturn. Some traders also use profit target markers, such as mid-range levels or previous highs, to further refine their exit strategy. By combining oversold entries, overbought exits, and crossover confirmations, this simple stochastic approach provides a structured and easy-to-follow system for navigating market swings and improving trade timing.